Fluency Session 7. If you recall, last time we went over the exit analysis, so that covered assumptions, continue building the story, and the simple and VC exit analysis models. Today we're going to look from the perspective of an operator at like operator ownership and exit. So this is related to the exit analysis from a different perspective. So 3 different sections here: 1, typical operator equity; 2, personal exit calculation; and 3, exit taxes and tidbits. So first, we're going to look at some data in terms of typical CEO equity. For the health tech segment, I recommend using Equitas, a digital health executive compensation survey. So you can see here that the main difference between founders and non-founders is founders get a lot more equity and non-founders get a lot more salary. So now looking at numbers more relevant for operators in the room here, gotten from the same data set. So a few things to see here. One is 1% equity seems to be pretty typical for pre-seed, unless you're on like the C-suite. And then once you get into seed and Series A, equity seems to level out around 1 or 2%. With a lot of nuance, right? Because 0.6% versus 1.2% is literally 1/2, and that very much matters in an exit. And if you look at data from Carta, you see that this tends to align, where equity is a function of a higher number, right? And earlier hires tend to be C-suite and whatnot. And like as time goes on, you really see this leveling out to that 0.1, 0.2% of equity. So now putting that into context, going over a scenario, or 3 scenarios. One is Science.io, which was a quick exit, 140 million acquisition only after raising 8 million in financing. 2 is Vivify Health. So this is the M&A exit. They raised 40 million over 4 rounds of financing, and they had a 700 million acquisition by Optum. And last year is Health Catalyst, which this is the IPO scenario. So a lot more time, 8 equity rounds, and 387 million raised. So that's up to Series G. So similar to how we looked at exit analysis, so the first thing to do is to calculate the dilution assumption. Again, here we're going to use 20% as used before. And based on the number of rounds, you get 80, 64, 51, 41, etc. Again, you can get a little more sophisticated with this and turn the dilution to 15% and probably around 3 to 6 or so. But for the purposes of this estimate, I think it's fine. So once you have that built out, it's pretty easy. You just put also the different exit scenarios, and then you calculate how much you would earn in the event of an exit based off what your assumed number of rounds until the exit would be and the exit price. This is an oversimplification, right? It doesn't count the cost of equity, which is sometimes negligible, not always. So we're going to go into that a little bit now. So continuing this scenario with 4 different positions here. First, looking at a CO of 7%, 9.8 million is a great exit for only 1 round of financing. And the 140 million, which doesn't seem like that much, but it's really due to that lack of dilution. And that dilution impact is seen here, where you actually make more money on the Vivify Health exit because of those 4 rounds of dilution versus the Health Catalyst, which was 8 rounds of dilution. Looking across the first operations director, right, the pre-seed 1% is 10x the seed 0.1%. And I consider the pre-seed amounts meaningful, while the Series A, the 0.1% numbers, 112, 350K, 167K, that's not really life-changing, right? That's that's like barely your student loan debt. And the VP of Business Development, the Series A of 0.6%, this is meaningful, like 6x the 0.1%, right? I mean, you can just multiply everything. So you can see, my take is exits get meaningful everyone around like 250 million. So here I'm looking at 0.1% operator, which is pretty typical. And you see that 100K exit with 3 rounds of dilution. The 0, 1, 2, 3 rounds of dilution. So 3 rounds of dilution, 100K, you're getting 51K, which is all right. But then when you get to 500K, that's 256K. That's pretty meaningful. And so around 250 million would be in between those two values. So you definitely get six figures at least. And this is often why VC-backed companies don't want to exit too early. Not everyone will be happy with a smaller exit, but you can see that small exits with minimal dilution, like Science.io did, do create meaningful exits. And we can go over this deeper later, but this is basically more of the robust operator exit analysis where there are two main differences. One is the calculation of the options that you need to purchase, which we'll go over in a second. And two, a more precise dilution estimate. And you're able to do this if you have the new investor price and the new investor raise for a subsequent round. And we're going to go over pricing around and help you explain a little bit more about this. The numbers are the same directionally as numbers from like the simple where it's just dilution based. But when you're thinking about like taxes and being more granular of your personal finances, sometimes you do need this more exact number. So now moving on to a bit of the taxes discussion. First thing to understand are the three different types of valuation. So first one is the 409A valuation. So this drives your taxes. It is formally defined by the IRS and often kept in CARTA. It is the number used to calculate anything related to taxes. Two is the public valuation. This is like valuation that when you hear valuation, this is like what you think. This really is in reality, it's the price that the investor chooses to pay. It does not have any direct tax implication, and this matters the most for exits. Lastly is QSBS. This one's confusing, but it's really niche. It does have really important implications in taxes, and it's basically whether or not your company qualifies as qualified small business stock. So a little more on the QSBS while we're here. Basically, if your company has less than 50 million in company assets, so assets, not what investors decide the valuation, then you get tax benefits. So you actually get 0% up to 10 million in gains, but you do need to hold on to QSBS eligible stock for 5 years. Moving backwards, public valuation. This is what we've been talking about this entire course, right? It's investor price per share. And every round, investors are selecting this new valuation. The 409 valuation, about to go a little bit deeper. Basically, it's the fair market value determined by IRS, and this is used for taxes calculation. So now going over like a scenario here. So trying to think of like a typical operator, 180K in salary, their strike price, which is the price that the employee could purchase equity by, and this is determined by the FMV, the 409 calculation, is $1 here. And this is different than what the company, the investor price per share is. So if we're assuming that total fully diluted stocks is 10 million, that means employer ownership is 0.1% of the company. And we're going to assume a $1 billion exit after the next fundraise. So during the next fundraise, or after the Series C. So since it's Series C, 2 more rounds of dilution. So instead of 0.1%, it's 0.064%. And let's just say the Series C FMV, which is the new the value of the stock determined by the IRS, is $40 here. And an important thing to note, again, to reiterate, there is no correlation between FMV and the investor price per share. So like the real world valuation that you see on Crunchbase, et cetera. So this is where things get a little tricky. I highly recommend using CARTA. They have a really great calculator, and it's what I use here. So basically, you plug in what your income is, and on the back end, CARTA will calculate what your income taxes are. And then based on your equity purchase, the government considers that when you purchase equity, you're actually gaining that value, and you have to pay taxes on that. Which in my opinion is a little silly, because sure, you're gaining that value, but until there's an exit, you're not going to see any of that cash. So it is not necessarily very beneficial for operators. And also you have to take on a risk, right? Because if that company doesn't exit and you're holding on to the equity, yes, you can write that off in the future. It gets very complicated, but you might often be better off not purchasing it. So in this scenario, when you purchase equity, you have to do this AMT calculation. So here, if you see here, you have 130 is like how much you should have paid based off exercising 10,000 shares, FMV of $40, and the strike price. So that's the strike price is the dollar value when you come into the organization at $1. So there's a 130K number, and then like how much you pay taxes normally. So here it's this 33K. And this is like an estimate. In New York, this actually be higher. So basically the difference between the AMT payable and the regular taxes payable is how much additional taxes you need to pay. This really matters when your company's later stages. So I did some math, and basically you don't have to pay any taxes at all if the FMB is less than $4.06. So like if you purchase at the seed or Series A, you'd probably be fine. Or you could also purchase less options, right? So this is assuming that I'm exercising 10,000 options at once. You could purchase 810 options and not have a tax implication, right? And like, I'm not necessarily advising you should buy your equity as early as possible because there's that risk, right? Earlier you purchase equity, the less information you have about the probability of company success. So it is a balancing act. You do think your company is going to be successful, and or your equity is very cheap, especially if you got on the pre-seed, then I'd recommend purchasing the equity. But if you're like later stages to the company, let's say like the FMV is like $100, which can happen like Series D, Series E, you might have like a tax burden of 5 to 6 figures. And maybe it's better to wait until the exit, or maybe just purchase some options depending on like what your salary and your personal situation are. So now going over these 3 scenarios with a real life tax implication. So one is if you purchase the seed and you hold on for 5 years, and this is when the company is QSB eligible, so the company assets are less than 50 million. 2 is if you purchase Series C's, but you hold on to the equity for more than 1 year. And 3 is you wait until the exit to activate. So in the first scenario, since the company is QSB eligible, you have 0% taxes on up to 10 million in gains. Again, you have to hold on this equity for 5 years, right? 640K. If you wait a year before you let go of the equity, so this could mean if either you purchase it before the exit and wait a year, or perhaps you purchase it at the exit right before and then wait for a year, then you only get the long-term capital gains tax, so that's 15%. So in this scenario, you do have to pay the options taxes since you waited too long and had that tax implication up front. But then you pay only 15% on the gains, so you take home like 446K. If you do not wait for any time and you let go of the equity right away, you actually get your normal tax amount, which is around 37%. And so you only get 305K, which is less than half of the QSBS situation. This might feel like an easy decision, but the thing is, a lot of operators don't have the cash on hand to purchase their options, especially in later stage companies where the equity investment could be 4, 5, 6 figures, and the tax implication could be even more. So you're often stuck in this scenario where you might need to wait until you get the gains from the exit in order to even purchase your own equity. And as a result, you kind of get hit by this larger tax bill, which in my opinion is silly. So that's it for Venture Fluency number 7, operator ownership exit. Can't wait for next time. Bye.